Principles of finance, a la shmup. Accretion, dilution, neutrality. All right, so Blade Runner bought Nanodrone, and the little girls in the Wall Street playground are already singing the song Blade Runner and Nanodrone sitting in a tree, Kissing. First comes banker, then comes merger, then comes the margin in the profit synergy carriage, or something like that. When one company buys another, the transaction ends up being one of three things after it closes, and the newly combined shareholder numbers are tallied. The deal was A, accretive, B, dilutive, or C, neutral. All right, well, the numbers are a giant shell game, however, so if someone quotes to you anything about these terms at a cocktail party, well, you should just leave the cocktail party. But then as you quickly walk to your car, you should wonder what set of numbers they were using when they came up with the verdict that the acquisition was, in fact, dilutive, accretive, or neutral. And the overlay here is that notionally, dilutive is bad, accretive is good, and neutral is, neutral. But it's not always the case. Many factors apply, as always, in finance. The rationale behind dilutive is that bad stems largely from the fact that equity owners, long-term ones, are often value investors, and they simply feel more comfortable owning a stock that has a low price-to-earnings ratio. Like at an extreme level, if the price-to-earnings ratio were 4 times, well, the company could buy back its own stock and get notionally, at least immediately, a 25% return on those incremental dollars being used to shrink its market cap, and buy back stock. So if a company had $100 million in cash on its balance sheet and no debt and traded for a valuation of $500 million and also had $100 million in annual cash earnings, it would carry an equity cap of $400 million. Got it to the market cap's 500. You subtract the cash on the balance sheet so that you just get the equity value of the company, and that equity value reflects the future earnings potential of the company. It's making $100 million this year and presumably more than that next year. But you take the 100 over the 400 and there you get 1/4 or 25%. So the company could spend that $100 million of cash in a few ways. Like it could buy back 20% of the shares outstanding. Why 20, not 25? Because there's $100 million of cash on the books, right? So it's a $500 million market cap. $100 million is 20%. Or it could just leave the cash sit there. Well, it could buy an even more undervalued company. For illustration here, that company, maybe it has no cash, no debt, but had $33 million in earnings. And if the company acquiring it paid $100 million for that $33 million of earnings, well, it would have bought it for 3 times earnings. So it would bolt onto itself a 3 times earnings company on top of its 4 times earnings valuation company. And the combined company, well, would have, with no savings or synergies, just as equity cap on equity cap, presumably $133 million in annual earnings. It would generate a ton of cash, and its 4x multiple would have been accreted somewhat, assuming its stock price and everything else stayed flat. That is, 4 times $133 million in earnings, about $532 million, a bit more than the $500 million before all the fireworks started. And you had $100 million of cash go out the door to buy future earnings and yada yada. So you got to kind of think about it in the long run here, not just the one-time transaction today. At the other end of the curve, it could pay up for a growth company at 40 times earnings, and that would be a dilutive acquisition, at least on these numbers, because combined, the $100 million purchase of that 40 times earnings company would have only bought $2.5 million in earnings this year to the company. So now they'd have $102.5 million in earnings instead of 100, but they just sent all their cash out the door. Combined, it would not be trading at a higher multiple than the 4x number it held before, i.e. it would be kissing the lofty multiple of almost 5 times earnings. Woo. So that's the gist of accretive and dilutive earnings. And in real life, Wall Street people grumble often about why companies don't just buy back their own stock if their own stock is so cheap that they're marketing to us Wall Streeters to buy. So their own price to earnings trading multiple is often the first stop now in figuring out whether the deal made financial sense or not. That's the theory anyway. So here's an illustrative question. Why would companies actively dilute themselves? Like, why would they ever pay a higher multiple for another company than the multiple at which they are trading? Because for a lower price, at least a lower earnings multiple, they could just buy back their own stock themselves. Well, in many cases, the real numbers are different. That is, a company on paper might appear to have been bought at 100 times earnings of $10 million. Like someone paid $1 billion for DreamAndDeliver.com. It had $300 million in revenues. But under the new owner's cost-saving system and bigger footprint, Dream and Deliver immediately grows revenues 20% and cuts $200 million out of their cost structure. So while before the acquisition happened, the company had only $10 million in earnings on $300 million of revenue, after the acquisition, that 10 went to 100, and the acquisition in hindsight was done at only 10 times trailing earnings. So it was a bargain. So yeah, the numbers all have to be metered and measured and evaluated as to being dilutive, accretive, or neutral in context and in what year. Like if you look 2 or 3 or 4 or 5 years forward and you really believe some company has a lot of growth in it, and then strategically it maps to the acquirer's core business, well then maybe the combined company gets its supplies cheaper, or it buys shelving space cheaper at retailers, or maybe it's just a bigger brand that then everybody knows, or I don't know, maybe there's other magic dust that gets sprinkled around it and makes the company combined have more heft and be more valuable, right? That's the goal anyway. Otherwise, if you don't do all these machinations, well, the numbers themselves can be deceptive and lead us astray, and we really don't need to give those girls on the playground any more ammunition.